Another week, another central bank monetary policy decision, and more debate over inflation, as the European Central Bank takes centre stage on Thursday the 22nd of July. No sooner had President Christine Lagarde announced no change in policy in June than Austria's central bank governor Robert Holzmann and Germany's Bundesbank's Jens Wiedmann both cautioned about the danger that inflation could take a grip and not be temporary or transitory after all. Holzmann asserted that 3% inflation across the EU should trigger an interest rate rise. Wiedmann warned price increases could hit 4% in Germany, and the Netherlands class not weighed in, also warning of upside risks. Now, the latest EU inflation reading, 1.9% increase year on year, down from the prior month's rise of 2%, may take off a little bit of the heat, but this could be an interesting meeting all the same. The US Federal Reserve tried to talk tough, or at least tougher than it has for a while, back in June, and it backpedaled pretty quickly after just one or two wonky days for financial markets. You can't help but think that the ECB will tread carefully too, and it's hard to see policy changing this month either, although economists, investors, politicians and bankers will comb Christine Lagarde's speech for any changes in tone. So just in case, the main refinancing rate stands at 0%, as it has since September 2019. And the Pandemic Emergency Purchase Programme, or PEP, has a current limit of €1.85 trillion from its inception date in March 2020 to its planned conclusion in March 2022. The latest version of the quantitative easing, or QE, programme has been expanded in scope twice already from its initial level of €750 billion. This means that the ECB's balance sheet right now carries assets with a value of €7.9 trillion, up 26% year on year. The base effect means the rate of growth is at least slowing down, but how the ECB can set about sterilising or withdrawing any of this stimulus is a bit of a mystery, given that even talk of slowing down QE prompts hissy fits in financial markets, not forgetting potentially many a prime ministerial or presidential office. Company-wise, we're on the cusp of the second quarter reporting season, which will run through much of August, and the coming week's proceedings therefore are mainly dominated by trading updates. Names which may be worthy of further study include the following, although do note some of these dates are still potentially subject to change. Recent market newcomer Parsley Box on Monday the 19th of July, Anglo-American, EasyJet and ASOS on the 20th, Antofagasta and soft drink maker Nichols on the 21st, SSE, Centrica and another soft drink specialist Britvic on the 22nd, before Vodafone and Premier Foods close out the week on Friday the 23rd of July. But the company which could just cause the biggest fuss in the week ahead is Unilever. The food to personal care group is scheduled to release its first half results on Thursday, the 22nd of July. Now, Unilever shares haven't done much at all over the past 12 months, although they do still trade above the level implied by Kraft Heinz's cash and stock offer of 2017, which equated to around £40 a share. Now, this fairly modest share performance is partly due to a slowdown in sales growth last year, especially in emerging markets, although first quarter sales in 2021 did beat expectations. The Magnum to Marmite and Dove to Domestos company also launched a €3 billion share buyback in May, but the shares have still largely shrugged, perhaps because investors have been looking for cyclical companies that could benefit from an economic upturn and unlocking of economies and show a rapid recovery in earnings rather than more steady Eddie firms like Unilever. Anyway, the first number that analysts will study here is underlying sales growth. This reached 5.7% in the first quarter, easily beating analyst forecasts and management's long-term goal of 3 to 5% growth. It was also the best number since Q3 2015. Progress was helped by good demand for food brands like Magnum Ice Cream and Hellmann's Mayonnaise, while home and hygiene brands such as Domestos and Lifebuoy Soap were also strong sellers, no doubt boosted by the lingering pandemic. For the second quarter, analysts have penciled in a 4.2% underlying rate of sales growth. For these first half numbers, analysts will then go behind the headlines and look at the mix of underlying sales growth between price and volume. After Q1's 4.7% advance in volume and 1% price increase, analysts are looking for 3.2% and 0.8% respectively for the second. Now, in the first quarter, emerging markets bounced back after a mildly disappointing 2020, with underlying sales growth of 9.4% compared to just 0.8% in developed markets. Asia led the way, while the Americas showed 5.3% sales growth and Europe dipped 2.3% on an underlying basis. Analysts will then turn to the headline profit figures, where Chief Executive Alain Jope and his colleagues use underlying operating profit as their main benchmark. The first half consensus forecast here is €4.8 billion, a fraction below 2020's €5.1 billion. For the 2021 as a whole, analysts are penciling in €9.5 billion of underlying operating profit for a margin of 18.6%. That compared to the management's medium-term target of 20%. Finally, the dividend will be of particular interest to shareholders. Unilever increased its quarterly distribution to €0.4268 a share in Q4, up from €0.4104 a quarter, and then held it at that level in Q1, when the payment was the equivalent of 37.1p a share. Currency movements do complicate dividend forecasts, but for the moment the consensus estimate is looking for around 148 pence a share for 2021 as a whole. That's enough to make Unilever the fifth biggest dividend payer in the FTSE 100 in cash terms at around £3.9 billion and equates to a dividend yield a fraction below 3.5%. On the strategic front, now that the share restructuring is over, an update on the company's proposal to sell the bulk of its tea business will be of interest. Unilever plans to retain the Indian and Indonesian operations, but plans to put the rest of the unit for sale, or at least into a separate unit, and they've got annual sales of around €2 billion between them. Unilever's also completed the separation of its smaller beauty and personal care brands into a new operation called Elida Beauty. Mr. Jope and his colleagues may choose to update shareholders here too, as they plot out a growth strategy for that particular unit. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.